Hey guys, I'm Phil Town from Rule 1 Investing, and today I want to talk to you about a few different types of investing strategies and how to determine the right one for you. If you're doing it right, investing in the stock market is a lot more than just picking up a few companies, buying a few shares, kind of hope for the best. Smart investors are disciplined and they have a strategy in place that guides them as they go along with their investing choices. So today, I'm going to go over 5 of the most common investing strategies and how to pick the right one for you. All right, the first one we could talk about is income investing strategy. This involves buying securities that are paying out dividends, a steady return on a steady schedule, typically. So this would be something like a mutual fund that has a lot of dividend production, dividend paying stock. Maybe you can buy some bonds that are producing a steady income. So securities that are paying returns is income investing. And this is kind of what people are hoping to do if they don't know much about investing. By the time they get to retirement, they're typically starting to load up on the bond side of these kinds of securities where they get almost a guaranteed income off of the bonds and a lot less in terms of stocks that are not paying dividends. They use stocks that are paying dividends. They're doing mutual funds that pay dividends. Now, the pros of this are that you can have a pretty decent amount of money come in relatively safely, which is the whole point of the thing. But the major con of this kind of investing is that you need a lot of money to start with, or the amount of money that flows into you isn't sufficient to live on. It's just not enough to do it. And these kinds of investments that you buy typically to get a cash flow from, often you're not considering the real value of the investment that's underlying it, and you have to hold it for a long, long time. This is not the greatest way to create a financial freedom, to create an early retirement. The rates of return are going to be very, very low, particularly in this environment. We're talking 1%, 2% returns is typical. Now, if you go for a higher dividends and a higher rates of return, you're starting to get into some serious risk that can really backfire on you. So if it's income you're after, you certainly don't want a lot of risk with it. Be very careful what you put your money in and be willing to accept a very low rate of return. Impact investing. This is a kind of an interesting strategy. It's being called a strategy. I almost don't know if it really is or not. The basic idea is you buy companies with a measurable social, environmental impact is the idea. I hesitate to call it an investing strategy. It's almost like a charitable strategy. In other words, people who do that are more interested often in the positive benefit of the things that they own to the society, to the environment, than the actual financial return. So the pros of that are that if you are, like many of us, very interested in having the companies you own be companies that reflect your values, that's a wonderful thing to invest in companies that do that. The cons are you better be rich, because this is a rich person's game. They got to have the money to lose, because many of these companies are massively overpriced or not even really viable as real companies. So I don't like the idea of impact investing as a strategy per se, because I think we can do the same job and really do well at making money if we're careful. We'll talk about that in a second. All right, the next strategy is growth investing. Now, this theoretically is the idea of investing in companies that have above average growth. So a lot of people who do growth investing are looking at the FANG companies. These are Facebook, Apple, Google, Netflix, right? These are companies with a lot of potential growth. They're really, relatively young companies often. And they have very high PE ratios, high price to book ratios. This was kind of popularized by Peter Lynch all through the late 90s when it was a go-go market and everything was rocking and rolling. That is not the market we're in today. And growth investing can be very, very, very bad for your investing portfolio if you are entering these companies at today's valuations. At best, you're going to see just okay returns, in my opinion. The pros are, if you get a continued low interest rate environment here, we just might see these things continue to rock and roll at a pretty decent rate of return. But I kind of think we're at the end of that scale. And the cons are, when this thing slows down, these are going to slow down a lot more than the rest of the market. and may even go down substantially. Growth investing. Don't really like the idea of investing just for pure growth. Small cap investing is a strategy that's kind of a spin-off of growth investing, because often small cap stocks are high growth stocks. They're also high risk stocks. They tend to be much younger in the market. They tend to be companies that are trying to come into a market. Sometimes they have a niche, sometimes they don't. Sometimes they are not even making any money. But in general, small cap stocks, which are tracked by the Russell Index, tend to grow much faster than the overall big cap stocks like on the S&P 500 or the Dow Jones Industrial Average. Lot more risk here, and you run the risk of getting caught up in the rotation that happens when big investors move money into small cap stocks to try to capture some of that growth, and then move their money back out again when the market starts to get shaky, and put it back over into the S&P 500 where it's safer companies in a recession or depression type market. That means the volatility among small cap companies is really high. And if you're picking just a group of companies by buying, let's say, the Russell Index, you can really see those things drop. You could see them drop 60 or 70% or more in a big recession. So the pros, okay, you might get more rate of return. The cons are you're going to have a lot more volatility, and it could be very scary. Now, value investing is often just the idea of buying companies when they're on sale at a price much lower than what they're worth. And this is the kind of investing that I do. Now, we don't consider value investing to be really its own separate kind of investing. In fact, if I was to clarify this all, I would say that value investing is the only kind of investing there is. That if you're doing it right, you're going to capture growth companies when they're on sale, small cap companies when they're on sale. You'll be putting money into income or dividend producing stocks when they're on sale, and you'll be putting money into companies that reflect your values, which would be the equivalent of impact investing. That's what makes, I think, this kind of investing the only real kind of investing that there should be. What we want to do as an investor, by definition, is we want to buy assets that produce cash flow that we can then evaluate. Where's this cash flow going to be in the future? What should I pay for this kind of cash flow? And we can pick those companies up, understanding quite a lot about them when they are on sale. So the pros for this kind of investing are that you are able to get the highest returns. This is the kind of investing that Warren Buffett does, Charlie Munger, Manesh Prabhai, Prem Watsa. So many great investors in the world. Most of them do this kind of investing. This is the only kind of investing I know of that produces consistently high rates of return, much higher than the market rate of return, for 30, 40, 50 years in a row, right? 50 years over a long period of time. So the pros of this is the highest return you can get, in my opinion, with the lowest risk. So this is very high rates of return with lower risk than putting your money into the stock market as a whole. Why? Because you're buying companies when they're on sale. You're effectively buying them during an economic contraction, during some kind of fear-creating problems. And you're buying these companies when they're already cheap. And then they tend to go up back to where they were. That produces extremely high rates of return. Now, the cons of this kind of investing are real simple. If you don't know how to do it, you can lose money. And that's the catch. This is the kind of investing that is required that you have an education. So this is what it all boils down to. If you want to invest like the greatest investors in the world, you get an education and you do value style investing, buying great companies when they're on sale, effectively buying $10 bills for $5. What's not to like about that? So now, how great would it be to learn this? I think great enough for us to teach it. So we put together a fabulous live virtual 3-day workshop that I teach with my incredible certified coaches, 3 days packed with information about how to do the kind of investing that's done by Warren Buffett, Charlie Munger, myself, and other investors like us. This is value investing at its finest. You're going to end up with cash flow strategies that you can do to create cash flow, and about 10 companies that hopefully will be some of the best companies to invest in if we're about to go into recession or depression, and knowing what price to pay for them. It's an invaluable workshop, you guys, that can set you on the path to financial freedom. Look forward to seeing you there. And by the way, love to hear from you. Have you ever used any of these investing strategies that we're going to be teaching at this workshop? And how did it work out for you? Now, leave a comment below with your answer. I'll be sure to follow up with you. Thanks for watching, you guys. Time to go play. You guys, if you enjoyed this video and you think it was valuable in teaching you more about the different types of investing strategies, just hit the like button and please share the video with your friends. And if you want more content about investing, just subscribe to my channel. And don't forget to click on the button on the screen for a free gift. Thanks again for watching. Time to go play.